Hi, this is Mark Chandik. Welcome to the latest edition of Prosperity Perspectives. Today we're going to talk about life insurance, a very confusing and complicated financial instrument. In this video, we're going to go over what exactly is life insurance, who should buy it, when they should buy it, how much is enough, what types are available, and the process to obtain it. So let's just get right to it. Life insurance is a contract between an individual and a company, insurance company. Insurance company promises to pay a death benefit in the future, you pay a premium. That's the deal. Pretty straightforward. Congress likes you to buy life insurance. They want you to buy life insurance because they provide a tax benefit. The death benefit is income tax free to the beneficiaries. That being said, the premium is not deductible. I'm asked that all the time. Premiums are not deductible for life insurance. So let's talk about individuals and why they should buy it. First and foremost, for income replacement. You're young, you have a young family, children at home, you're saving for college and retirement. You need life insurance in case you die unexpectedly. Secondly, companies. Companies fund corporate agreements. What are corporate agreements? Buy-sell agreements. One party promises to transfer their interest to the other party if they die prematurely, especially in a family-owned business. The third are wealthy people who actually have done quite well in life and created a lot of wealth through real estate and business interests. Oftentimes they have no cash. They're very asset rich and they're cash poor. So life insurance can be injected in their estate to pay taxes and equalize the estate, things like that. So how much is enough and how do you calculate it? Well, there's an easy rule of thumb for individuals. If you have a family and you're trying to replace your income, the standard rule of thumb is about 8 to 20 times your income, or what I call the 5% rule. Because what life insurance is intended to do is that the beneficiary will take that life insurance amount and invest it very conservatively. So I use a 5% return assumption. And they're going to take income on that money, and that is going to replace what they have lost because you've died prematurely. So by using that particular rule of thumb, you can replace up to 100% of your income if necessary. You can also include mortgage payoff and also a lump sum for sending children to college, for example. How do companies determine how much is enough? They determine that looking at earnings and profits that would be lost if a key person dies in the company. Or if it was a buy-sell agreement, what is the fair market value of the company? Wealthy families, as I said before, buy life insurance for equalization and also for federal estate tax payments. If you have a privately held company, a family-owned business, and the value is over $27 million, which is the current tax-free amount that can be transferred to the next generation, life insurance can pay the taxes so that company is not sold in order to raise the cash to pay the government. Is this expensive? It sounds expensive. It can be, but it's just a tool. And there are different types for different purposes. So we're going to look at the two basic types. The first type is the least expensive from a cash flow perspective. That is term life insurance. And I'm sure you've probably heard that from people. Buy term insurance. Term insurance comes in different durations from 10 years all the way out to 30 years. When you're young, you can get up to 30-year term insurance. When you're older, over age 50, you don't qualify for 30-year term insurance. It is the least cash flow requirement in buying life insurance. There's no frills that come along with it. The second type of insurance has a savings or investment component, and it is designed to go to stay in place for no matter how long you live, age 85, age 90, age 95. There's a lot of names for these, and it can be quite confusing. Whole life, variable universal life, indexed universal life. But what they all have in common is a savings component that can be utilized for college funding or to supplement retirement, and that policy can be in place for as long as you live. The downside, of course, is the cash flow or the premium funding is higher than term insurance. The third basic offshoot, I guess I'd like to mention, is mortgage insurance. When you have a mortgage, you're going to get a solicitation from the bank typically that says that they will offer you life insurance that will cancel the mortgage if you die unexpectedly. And so it looks like an easy deal. It's just sign here and you get it done. But what is actually happening is that that's a term insurance policy whose death benefit is going down as your mortgage is reduced, even though your premium remains level. The bottom line with this is that if you're medically able to qualify for insurance on your own outside of that, then it's less expensive to do that. So really buying mortgage insurance, in my opinion, is the last resort if you can't purchase it and qualify medically. So what's the process of obtaining? Well, the insurance company is going to want to look at your medical information by either filling out a form and listing your medical information, or you're going to have to submit to a insurance physical, a very brief physical where a nurse will come to you, your home or office. They take a blood sample, a urine sample, and they ask you medical questions. And the insurance company is going to look at your medical information, and they are going to offer you a policy, and they're going to offer you at a price that is either standard, preferred plus, or they may not offer at all if your medical information is so bad. But most people qualify for standard, and you get about a 20% discount if you qualify for preferred, and about a 40% discount if you're preferred best. And if you're young and healthy, then you should qualify for preferred best. Once that policy is approved and you accept it, you pay a premium, and the deal is done. Now, the one thing that you should know are during the first 2 years of all life insurance policies, there's what's called a 2-year suicide clause. So if you take your own life during those 2 years, there's no insurance for your family. The second is a potential problem if you make a material misstatement on the application. In other words, you lie on the application. For example, you tell them that you don't smoke cigarettes and you smoke 2 packs a day. Or you had bypass surgery and you told them you didn't have any cardiac problems. That is going to trigger a material misstatement, and the insurance company then can get out of that claim. I hope you enjoyed this episode of Prosperity Perspectives, and I hope to see you again soon.
Your Chief Prosperity Officer, securing your future together. Advisory services offered through FDP Wealth Management, LLC, a state-registered investment advisor, and ValMark Advisers Inc, a SEC-registered investment advisor. Securities offered through ValMark Securities Inc, member FINRA/SIPC. 130 Springside Drive Suite 300 Akron, OH4433324431. 800-7655201. Prosperity Partners and FDP Wealth Management, LLC are separate entities from ValMark Securities Incorporated and ValMark Advisers Incorporated. Prosperity Partners, FDP Wealth Management, LLC, ValMark Securities Incorporated, ValMark Advisers Incorporated, and their representatives do not offer tax advice. You should consult your tax professional regarding your individual circumstances. The information provided has been derived from sources believed to be reliable, but is not guaranteed as to accuracy and does not purport to be complete analysis of the material discussed, nor does it constitute an offer or a solicitation of an offer to buy any securities, products or services mentioned. This material has been prepared for informational purposes only, and is not intended to provide, and should not be relied on for, accounting, legal or tax advice. The services of an appropriate professional should be sought regarding your individual situation.